Hello friends, today we are going to discuss one of the important risk of the banks, that is credit risk. And this is very important because banks' main business is to lend, and bank cannot definitely try to hedge their credit risk and think of making money. So being very close to the corporates or customers, they are in the best of the position to manage credit risk. So basically we will talk about the credit risk, then credit risk management framework, type of credit risk the banks face, credit rating, which is an important measurement of credit risk of a corporate, and then what are the credit risk mitigants, and we also briefly discuss about securitization and kind of the credit derivatives. Credit risk is the risk of loss that may occur from the failure of the counterparty to make payments, and it is also synonymous with what is known as a default risk or a counterparty risk. And one is the inability of the counterparty to pay his obligations. Another is, if he is a rated corporate, even the deterioration in the credit quality gets reflected in downward migration of a corporate. So if a AAA customer is now migrated to AA, definitely the credit risk for the bank has enhanced. So that is how we look at the credit risk in the bank. So diminution in the credit quality of the borrower, and also the what we know as a spread risk. Now with the government securities being always said to be risk-free, so always credit when it is traded, normally it is traded by way of spread between the coupon which the government securities pay and the coupon which is paid by the corporates. So normally if there is a credit spread widens, it is an indication that the credit quality of the corporate paper is worsened. Mostly the commercial banks are predominantly, they are the lenders. So basically the first one comes from direct lending. So if there is a default from the borrower, there is the credit risk. This also applies to the credit card dues. If the credit card dues are not coming forward, this also is a default risk on account of the banking activity. Now we know that bank also issue guarantees, open letter of credit for their customers, and there could be occasions wherein the customer is not able to pay his obligation in time, and these liabilities under these guarantees and letter of credit get crystallized, which the non-fund based exposure becomes a fund-based exposure. Treasury operation, Treasury also deals with several counterparties, and we know that the over-the-counter contracts, derivatives or any kind of transactions are exposed to the credit risk, and if there is a default on the side of the counterparty, the bank is exposed to a credit risk. And in case of the exchange traded contracts, definitely there is not much of the credit risk, because now the risk is on the central counterparty. And banks, when they are dealing with the corporates on their behalf or on their own behalf, may take some exposures on the international banks. So banks also in such cases also face what is known additionally as a country risk or sovereign risk, which basically comes out of the action of the foreign government putting an embargo on the payment by their corporates or the borrower to the international organization. Now let us understand the credit risk framework. On the top of, we have seen that the risk management is a board-driven function. On the top of the credit risk framework, risk management of the board will be there, and then at the executive level, mainly consisting of senior executives, what is known as credit risk management committee. Basically they will are the authority who will try to implement the board directions as far as the credit risk policies, guidelines are concerned. And at the operating level, policies becomes very critical as far as the credit risk is concerned, because we have, as we said earlier, credit risk is something which the bank has to manage if it has to survive for long, because this is one risk for which the banks get the returns and that is the only one of the major source of income for the bank. So the policy level, we will have credit policy, then we will have authorization manual which will give the delegation of powers, and there will be product specific policies. We know that each product, though it is a loan product, will have a different credit features. The kind of risk is not uniform along all the credit products. So product policies also becomes very important. And then at the business unit level, these are the business lines. Basically, we can segregate in a bank a business line as far as the credit delivery is concerned into two groups. One is the corporate group and the other is the retail group. Corporate group is the one which generally deals with proposals which are of higher denomination. Now, the credit risk management, again, when we say about credit, we said broadly we can divide them into a corporate group and retail group. Accordingly, the business line also will have, when it comes to the risk management, it has to be managed in a different way. You need to manage the corporate risk in a different way than the retail credit. We will see the approaches. What are the approaches for handling the credit risk at the corporate credit level and at the retail credit level. Now, when you talk about the corporate credit, one of the important parameter for measuring the risk is the credit rating of the corporate, whether it is external or internal. Since we are talking about the credit risk management, we will talk about the internal rating more, so that we understand what are the different kinds of risk that goes into when you rate an internal corporate. The important part for the within the risk management group, for the risk management group within the bank is independence. The business risk management group should not have any business targets. That is very, very important. And they should be independent reporting relationship. They should be reporting directly to the higher authorities and not to the business line. And they should be in a position to give their unbiased feedback to the management, whether it is about the quality of the portfolio or the quality of the underwriting of the new loans, etc. Now, when we say credit risk management, important thing is the credit risk identification, because we have seen that the risk management's very first step is to identify what are the different kinds of risk in the bank. Now, in case of a credit risk, first is to identify the default risk. And default risk is, we know that when the counterparty is not in a position to pay his obligation. And the second one we have seen is how to identify a possible downgradation. That's basically the credit spread. So if a corporate's rating gets downgraded, the bank is facing a higher credit risk. So it is very much essential to know that, to track the rating of the corporates. And then comes the portfolio, because not all the risk in the bank can be diversifiable, because systemic risk, when you are lending to different sectors, the sector specific risk cannot be diversified once you take the exposure. So these are basically known as systemic risk or intrinsic risk. So they are non-diversifiable, so it needs to be managed by a continuous portfolio analysis. And when bank, either geographically or industry wise, gets exposed to, or even the country, specific country gets a larger exposure, then what is known as a concentration risk. Because if there is a concentration of risk, the failure of a particular industry or a corporate in a geographical area or a corporate group as well can lead to higher losses, credit losses. Now, depending on the risk environment and the quality of risk management proficiency within the bank, this is the path for managing the credit risk in the bank. The first, of course, it starts with the individual rating of the corporates. Then comes the risk-based pricing. We have seen that the bank should be in a position to calculate the default rate and the recovery rate, keeping the historical record of the recoveries and the defaults within the bank. And then based on that, expected loss charge, capital charge needs to be loaded in the pricing when we are lending. And in the top is the portfolio management, which really talks about what is known as risk-adjusted return on capital and risk-based exposure limits and portfolio analysis. This becomes very key when we have a very advanced risk management system for credit risk management. Now, in the credit rating, let us understand about this as being a very key for corporate credit risk management. So we know that when the credit risk rating has to be done, it has to be done independently by the risk management department. So, and we know that we definitely cannot manage a portfolio without actually knowing the quality of individual customers or the whatever. Even if you are talking about the investment portfolio, the best way to analyze any portfolio from the credit risk perspective is to know the individual rating and probably then group them and then see how my portfolio is having the exposure to the credit risk going by the composition of a credit rating wise. So we know that internal rating in the Basel II itself, the Basel II talks about internal rating. So the internal rating becomes very key. So it should be an independent unit within the bank to assign rating, and rating has to be a part of your credit decision making, whether it is whether to accept the borrower or not to accept, or even the pricing. Everything has to be linked to the rating once you start internally rating the corporates. And you know that in the Basel II, to quantify the credit risk internally, we need to compute what is known as probability of default. Now let us understand the role of rating in the credit risk management. The first one is credit rating process itself. We rate the customer to decide whether we can accept the kind of risk which the new customer may pose to the bank. Next is the approval, and most of the banks, and even once you start rating a customer, the ratings are used as a very important parameter for deciding the approval process. You can decide upon who can approve what kind of rated customer. So it helps in risk-based approval hierarchy also. So what it says is the risky borrower, the sanction has to be at a higher level. That's what it says when you talk about risk-based hierarchy. And the credit rating also helps in the monitoring of the portfolio, because we know that the rating basically signifies the credit riskiness of a borrower. So the higher rated corporates which have a lesser likelihood of default need not be monitored that intensively when compared to those lower rated borrowers where the probability default is high and they are more likely to default. So monitoring, you can always, the frequency of monitoring can be fixed based on the rating. And also when we know that when the bank face NPA issue, it becomes very important that they have to prioritize their recovery and monitoring efforts. And if you have a ready database according to the rating of the corporates, it helps to concentrate efforts on the low rated customers who are likely to be defaulting. And reporting, because the top management needs to know about the health of the credit portfolio. The health, when we say, it basically comes out of the composition of the whole portfolio rating wise. So it is a very important input for reporting and making an analysis of all the segments. Bank may be lending to different sectors, but then it needs to analyze whether it's making enough returns for a particular rated category across all the segments. So this is basically the typical credit rating process involves, so initiation of the rating by the business group. They will recommend of collect all the inputs which are required for rating corporate, and with that detailed appraisal note, it will go to the risk management department. The risk management department independently will assess the rating of the corporate, and whenever they need some clarification, they will discuss with the business group, and finally a rating either by an individual in the risk department or by a committee in the risk department, will be conveyed to the business group. It's a process itself involving capturing the qualitative and quantitative factors, which represents in a way directly or indirectly the riskiness of the borrower. So basically all those parameters which will judge the borrower when you are assessing a credit proposal becomes an input for the credit rating model itself. So basically we assess external risk. External risk comes out of the industry risk in which the corporate belongs. And then the internal risk we have, which is specific or systemic only to the corporate, business risk, management risk, and financial risk. That when you add up this, what you will get as a company rating. Then if the company is doing a project, the project risk again needs to be identified. So when you add company rating to the project risk, what we get what is an overall risk rating for the corporate. Now the industry risk assessment comes out of industry characteristics and industry financials. And the business risk basically comes out of the market position of the corporate, what is the market share, how he is positioned, what are the product ranges, and what is the brand equity. This will decide, give some weightage to all these parameters, and we get some score out of market position of the borrower. And operational efficiency comes out of the operating parameters for the corporate and vis-a-vis the industry, and the cost efficiencies which the corporate has. And the management risk basically comes out of the track record of the borrower and attitude to risk and financial conservation, basically coming out of what is the propensity for the large project and the accounting policies, investment policies, and other parameters like group transactions, succession plans also counts when we have to decide on the management risk. The financial risk is very, this is the one which is very much quantitative, wherein it purely comes out of the financial position, existing and future financial position, and the accounting quality which you probably will be able to get from the financial reports, audit reports, audit comments in the published financial statements. And the financial flexibility talk about the ability of the borrower to raise funds in case of an emergency, or what we call alternative sources of funding. This all will decide the financial risk. Now in case of a borrower who is undertaking project risk, basically because the project implementation, it depends upon a lot of outside agencies, whether it is technical, political, or environmental. So it is very necessary to analyze a corporate borrower proposal from the project risk perspective, whether and how sensitive the project is to particular financial parameters also becomes very critical. Now when we have all these parameters, what is important is having a ratings model. It's also important to have a scale of so that we can fit in the borrowers which the bank has decided to accept. So need to have clear internal rating definitions. So we need to define what is AAA. Suppose we say that the bank is rating, we call it that bank AAA. So if the bank says internally a customer is rated AAA, there needs to be very clear description of each rating category and the sort of an definition what that AAA internally means across the business lines. And obliger rating, you know that it clearly the indication of obliger rating is the probability of default, and we know that Basel II itself has specified that the rating migration can be used for computing the probability of default. And sometimes the corporate also provide additional securities. The bank do lend against the collaterals. So depending on the collateral available, the defaults will depend upon the kind of collateral securities the bank has taken for a particular facility. So in addition to the obliger rating, we also need to rate a facility. A customer may be having a cash credit which is against the stock. The customer may also have a term loan against a mortgage of some property or machinery. So we need to rate each of these facilities to, at a later stage in the Basel II to compute what is known as loss given default, because loss in a particular exposure in a facility will depend on the kind of security as well in addition to the obliger. So there need to be adequate grade to facilitate risk differentiation. So only the credit score approach like accept or not to accept kind is not enough when you are managing a very large portfolio. And all this needs to be periodically refined. Whatever rating scales are there, depending on the circumstances, you need to analyze your own portfolio and need to compare the changes, migrations which are happening across the scale, and need to fine-tune the benchmarks which are required for the proper monitoring. Rating consistency becomes very, very important. Whatever the rating you are doing, the system needs to be stable and produce consistent results. When I say consistent result, basically what I am referring is to the similar set of parameters. If you have two corporates, the system should definitely give you a similar kind of a rating. So, and over the period, it's also the rating has to be consistent. Development and documentation of rating methodology and benchmarks is very, very vital. This is what the regulators also have been insisting. So you need to document the whole methodology, and even if you are changing some parameters for rating, you need to document them. And committee-based approach is prepared because to avoid individual bias. And process flow is another important part. How do you capture the data which is required for the credit rating? And all your models need to be externally validated. Now, what is the role of a rating? Rating indicates, as we have discussed earlier, a probability of default. When we say that AAA rating may imply a PD of 0.2, but a default rating D, which is a probability of 100%, which means all the customers in this grade are certain to default in the coming year. That is the indication of PD of 100. So as we have seen earlier, PD basically is a ratio of number of companies that have defaulted during the period under review to the total number of companies in that rating category at the beginning of the year. So what is the role of the rating scale? Rank ordering of the obligers. That is what we said. Basically it puts them in the order of their likelihood of default. A AAA one is the one who is not going to default, will be on the top, and the D1 who is probably is going to default will be at the bottom. All belonging to the same rating grade will have the same PD.